Think you've missed the investment train just because you're in your 40s? Think again. It might shock you to learn that many people don't start investing until later in life, yet they still manage to build substantial wealth. In fact, a recent study revealed that nearly 40% of investors didn't begin their investment journey until after the age of 45. Your 40s bring a unique blend of life experience and financial maturity that can actually turn into your biggest investment advantage. This video will debunk the myth that it's too late to start investing in your 40s and will arm you with strategies to maximize your financial potential. From catching up on retirement savings with smart strategic moves to leveraging cutting-edge technology to manage your investments, we've got you covered. Stay tuned as we explore how you can not only catch up, but potentially outpace others who started earlier. Let's turn the so-called late start into a strong finish. Ready to change your financial future? Let's dive in. Chapter 1. The 40s Advantage. Why your wisdom is your wealth. Investing in your 40s might sound late, but it's actually a golden opportunity. You see, by this age, many have gained valuable life experience and a clearer understanding of their financial goals. It's like Warren Buffett says, the more you learn, the more you earn. And in your 40s, you've learned plenty. One of the top strategies for 40-somethings is to focus on diversified investments. This isn't about putting all your eggs in one basket. Think of it as spreading your seeds in multiple fertile grounds to grow a lush garden. Statistics show that well-diversified portfolios can reduce risk and increase potential returns. Next, consider the power of maxing out retirement accounts. At 40, you're allowed to contribute more to retirement funds like 401ks and IRAs. This isn't just saving, it's smart investing. The IRS states that individuals over 40 can make additional catch-up contributions, potentially lowering your tax bill while boosting your retirement savings. But don't forget about debt management. It's crucial at this stage. The aim is to reduce high-interest debts that can eat into your potential savings. According to financial experts, paying off debt can be considered a return on investment. For instance, paying off a credit card with a 20% interest rate gives you a 20% return by saving that future interest. Another key aspect is to invest in yourself. This could mean upgrading your skills or even changing careers if it increases your earning potential. Data shows that mid-career education can lead to a salary increase of up to 20% or more. It's never too late to add more tools to your financial toolbox. Chapter 2. Late Bloomer Boom. Unleashing your inner investor. If you're starting to invest in your 40s, you're not alone. Many successful investors began later in life. Ray Kroc, the man behind McDonald's massive expansion, didn't start until he was 52. His story shows it's never too late to start a profitable venture. In your 40s, it's time to harness that inner investor by focusing on growth stocks. These are stocks from companies expected to grow at an above-average rate compared to their industry. Though they can be riskier, the potential returns can be substantial. As of last year, growth stocks have outperformed the broader market by 15%, according to financial analysts. Another strategy is real estate investing. It's a tangible way to build wealth, and it's not as intimidating as it sounds. With platforms like REITs, real estate investment trusts, you can invest in real estate without owning physical properties. This method offers liquidity, and historical data indicates REITs have provided returns competitive with those of equities. Also, don't overlook the potential of side hustles. They can be a great way to generate extra income to invest. Whether it's freelance writing, consulting, or selling products online, side hustles can significantly boost your investment capacity. Reports suggest that nearly 30% of adults in their 40s and 50s have a side gig aside from their main job. Investment in knowledge pays the best interest, as Benjamin Franklin famously said. Staying informed and continuing to learn about financial markets and investment strategies can dramatically affect your success. Regularly reading books, attending workshops, and following market news can equip you with the knowledge to make wise investment decisions. Chapter 3. Investment Time Machine. Fast-tracking your finances. When you start investing in your 40s, think of it as hopping into a financial time machine. You might be starting later, but there are ways to fast-track your journey. One effective strategy is leveraging compound interest. Albert Einstein once called compound interest the eighth wonder of the world. He's not wrong. By reinvesting your earnings, you can significantly accelerate your financial growth over time. For example, if you invest $10,000 at an annual return of 7%, reinvesting the gains rather than spending them, your investment would grow to over $29,000 in 20 years. It's like planting a tree and watching it grow taller and stronger from the seeds of its own fruit. Another fast-track method is to take advantage of tax-efficient investments. Tools like Roth IRAs or 401ks are perfect because they allow your investments to grow tax-free or defer taxes until retirement. This can mean more money working for you over the years. The IRS updates contribution limits annually, so keeping informed can maximize your opportunities. Also, consider higher risk, higher reward investments. While these should be approached with caution, allocating a portion of your portfolio to high growth options could potentially boost your returns. It's vital to balance risk with the stability of bonds or index funds, which historically have provided steady, reliable growth. Automating your investments can also play a big role. Setting up automatic transfers to your investment accounts eliminates the temptation to spend that money elsewhere. Financial advisors often say pay yourself first, and automation makes this effortless. Plus, it helps in dollar cost averaging, reducing the risk and stress of market timing. Chapter 4. Risk and Reward After 40. Finding your balance. Navigating risk and reward in your 40s can feel like walking a tightrope, but with the right balance, you can walk confidently towards your financial goals. Start by assessing your risk tolerance. This isn't just about how much risk you can stomach. It's about how much you should take based on your financial situation and goals. A common rule of thumb is the 100-age rule, suggesting that if you're 60% of your portfolio should be in stocks and the rest in bonds or other less volatile assets. This blend shifts as you age, gradually reducing risk as you approach retirement. Another strategy is to focus on value investing. This involves buying stocks that appear underpriced by some form of fundamental analysis. As Warren Buffett advises, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Look for companies with strong potential for growth and stability, a strategy that can mitigate risk while offering solid returns. Diversifying across different asset classes and geographic regions can also reduce risk. If one market performs poorly, another might compensate. For instance, while the US stock market might be down, emerging markets or real estate investments could be up, balancing out your portfolio's performance. Utilizing stop-loss orders is another practical approach to manage risk. These are designed to limit an investor's loss on a security position. Setting a stop-loss order at 10% below the purchase price limits potential losses, providing a safety net as you explore more aggressive investments. Chapter 5. Retirement Readiness, Catch-up Tactics That Work. So you're in your 40s and worried about retirement? Well, it's time to deploy some catch-up tactics that can really turn the tide. One of the most powerful tools at your disposal is making the most of catch-up contributions. If you're over 40, the IRS allows you to contribute extra funds to your retirement accounts. This isn't just about saving more. It's about leveraging tax advantages to grow your nest egg faster. For instance, in 2023, you can add an additional $1,000 to an IRA on top of the standard $6,000 limit, which can significantly impact your savings over time. Imagine if you invest that extra $1,000 annually with an average return of 7%. By the time you retire, that alone could grow to be a substantial sum. Another tactic is to reassess your retirement goals. Be realistic about what you want your retirement to look like and how much it will cost. Financial planners often suggest that you may need up to 80% of your pre-retirement income to maintain your lifestyle in retirement. Adjusting your investment strategy to meet these needs can make a big difference. Additionally, consider delaying Social Security benefits. While you can start receiving benefits at 62, delaying until 70 can increase your monthly payments significantly. For every year you delay past your full retirement age, your benefits increase by about 8%. This can be a crucial strategy for maximizing your retirement income. Chapter 6. Tech-Savvy Investing, Tools That Make a Difference. In today's world, being tech-savvy can give you a significant edge in managing your investments, especially if you started investing later in life. There are numerous financial tools and apps designed to make investing simpler and more effective. For example, robo-advisors can manage your investments automatically, using algorithms to adjust your portfolio based on your risk tolerance and investment goals. Using these tools, you can set up automatic rebalancing, which ensures your portfolio doesn't stray from its intended asset allocation. This is particularly important as different investments grow at different rates. By automatically rebalancing, you ensure that you're not overly exposed to any particular asset class, keeping your risk level consistent with your goals. Another handy tool is investment tracking apps. These can provide you with real-time updates on your portfolio's performance, alert you to market changes, and help you make informed decisions quickly. Such timely information can be crucial, especially when the market is volatile. Investment calculators are also invaluable. They can help you forecast how your investments will grow over time, allowing you to adjust your contributions or investment choices as needed. For example, if you're trying to determine how much more you need to save to meet your retirement goals, an investment calculator can show you the impact of increasing your monthly contributions.